Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hour Show. We've got a bunch to dive in today. The market flip-flopped and fell hard into the close, so we had a down red day today. If you are trading in this market, boy, oh boy, it does feel like it's counterintuitive, but selling on green days is so important. Don't wait for a red day to sell. You sell when the market is going up, and you don't have to sell it all. You can take it and chop it up into fractions and sell a third 2% up, sell a third of it 5% up, sell a third of it 6% up. That's how you make your gains. Don't sell when the market is red. That's when you want to take the time to buy. You want to buy on red days, sell on green. It seems counterintuitive because you never know. Oh, today was a green day. Is tomorrow going to be green too? Am I going to extend these gains? You're not guaranteed that. You're not guaranteed any gains at all. So you have to take them when they come. And this market right now, with it bouncing back and forth, so convictionless on which direction it's going to go, you got to take what you can get. And sometimes it just can't be that 10%. You got to take it when you can. So we're going to talk about a bunch of stocks. We're going to do a deep dive on Taiwan Semi and also KB Homes. They had their earnings report today, so we're going to get into that. A couple of stocks that we want to get into on rapid fire. ENPH, for example, was upgraded today. So a bunch to talk about. But the most important thing, the whole reason why I do this show is for you. What's on your mind? If you have a question, leave the ticker symbol in your question in the comments, and we will go over it live during the show. So while you get your questions ready, I'll just go ahead and jump right into it. But first, so in our current market conditions where there's a growing divide between value stocks and growth stocks, wouldn't it be great to know what the top 10 stocks are in categories like value, growth, dividend, and momentum? Well, there is. We just uploaded our top 10 stocks list for each of those 4 categories. That's over 40 high quality stocks ready to choose from that are constantly updated. We just updated our dividend list today. It's ready to go out. So you always have the best names available. So click the first link in the description or the link in the live chat to become a member and get instant access to our top 10 value, growth, dividend, and momentum stocks, and so much more. We've done the research so you don't have to. Okay, stocks traded lower today as tech stocks really weighed on the 3 main indices. The S&P 500 dropped 1.4%, falling below its 50-day moving average. And that's a very important average when we're trading and investing. Remember, bullish above, bearish below when it comes to the 50-day moving average. Now, the tech-heavy NASDAQ, it plunged 2.5%, while the Dow Jones erased as much as 175 points after adding 200 points earlier in the session. The Russell 2000 was also down 0.8%. Investors continue to digest the fresh inflation figures, which we got yesterday, which reinforced the Fed will not need to raise rates faster or at a faster pace than earlier announced. At the same time, initial jobless claims rose for the first week of the year when the Omicron spread started to disrupt activity, but remained within a level consistent with a healthy job market. On the corporate front, Boeing shares rose more than 2% after Bloomberg reported that the 737 MAX jet is poised to resume commercial flights in China as soon as this month. Also, Delta Airlines added 1.8% after the company's earnings beat forecast. That also helped to raise other airline stocks. Meanwhile, mega caps such as Tesla and Microsoft, they weighed on the market after falling 7% and 4%. While Snap, boy oh boy, it sank more than 10%. The information technology sector in the S&P 500, it was down 2.7%. Consumer discretionary down 2.1%, and communication services down 1.4%. Those were the sectors which contain a lot of the mega caps underperformed, along with the healthcare sector down 1.6%. The utilities actually gained a 0.5%, and industrials gained 0.2%, and consumer staples also gained 2.2%. Those were the sectors that closed higher. The retreat in growth stocks started shortly after the open, even as the Treasury market remained calm and the 10-year Treasury yield declined by 1 basis point to 1.71%. It's really been hanging around that area. Some surmised that the recent rebound in growth stocks, like the green that we saw over the past couple of days in the market for growth stocks, presented a good opportunity to take profits on the belief that growth will underperform value this year. And this only reinforces what I said at the very beginning about the divide between value stocks and growth stocks, and why our top 10 lists are so important. Investors received more inflation data today in the Producer Price Index for December. The index for final demand increased just 0.2% month over month. The estimate was 0.4% month over month, amid a sharp decline in oil prices. But it's important to note that oil prices have since reclaimed those losses from December. So they are now up in January. In earnings news, Taiwan Semi, ticker symbol TSM, and KB Homes, ticker symbol KBH, each beat EPS estimates, with Taiwan Semi also guiding Q1 revenue above estimates as well. We'll go deep on those in just a moment. As a reminder, several big banks will report earnings prior to Friday's open, like Jpmorgan Chase, Wells Fargo, Citigroup. We have two of those in our Catalyst Watch for tomorrow. Now, let's turn our attention to cryptocurrency, Bitcoin and Ethereum. Both of them are down over 2%. On TradingView, it's BTC. Get my cursor right here. BTC USD on TradingView. There is a link in the description for a free account to TradingView. And as we look at what happened to Bitcoin today, basically it gained 2.7% yesterday, and it's down 2.6% today. So it's basically giving back the gains that it had made yesterday. But the promising note here is that it still remains above this all-important ascending trend line. And it has been that way since it fell to that trend line on January the 7th. So since then, it has remained above that trend line. And for me, that's a promising note to point out here for Bitcoin. Now, that death cross that we talked in great detail about yesterday is getting really close. Inside this purple circle here, the blue line and the yellow line, they are about to cross. It looks like it may be tomorrow when the death cross may occur. Now, we went into this in great detail during yesterday's live stream. We talked about the death cross, what it means. Me personally, it's a lagging indicator, which means we've already been in a downtrend and we may have already seen the bottom. Because a lot of times with a death cross, it is a sign that you've hit the bottom and a rally is incoming. It happens all the time. We pulled up Ally Finance yesterday, and they had a death cross not too long ago, maybe about 2 to 3 weeks ago. And they have rallied really nice since their death cross. So it wasn't a big thing to worry about. And 9 times out of 10, this death cross isn't a big thing to worry about and to get freaked out about. It's just something that happens on the chart that is a lagging indicator, meaning we've already gone through the downtrend. And if we look at Bitcoin here, we've been falling ever since the high of 69,000 set on November the 10th. We have been in a downtrend since then. However, it does look like a potential turnaround and bounce off of this trend line down here that we hit on January the 7th. So, even though this death cross is incoming, it's a potential that we've already seen the bottom. If not, we could have a few more days of being in the red, getting back down to that trend line, maybe hugging along it, and then rallying. That's a possibility. The last death cross that Bitcoin had, that's exactly what happened. The death cross occurred. We went down for a few more days, and then we rallied. And we rallied all the way to the new, at the time, the new all-time high of $69,000. So again, death cross, not something terribly to worry about. It is something that occurs, and it's a lagging indicator. All right, now Bitcoin is down 2.8%. It's at $42,660 right now. It was as high as 44,500 and I'm sorry, 44,453 today. And it's gotten as low as 42,649, right where it is right now. So here we are. Let's go to Ethereum ETH USD on TradingView. Oh, I clicked the wrong source. ETH USD. They added Gemini in here as a source now for the Ethereum data. That's new. But I get my data from Coinbase. That's the source that I use. All right, here's Ethereum. It's down 3.4% now. It was down 2.8% the last time I looked at it. It's at 32.57 right now. And again, it's basically giving up the gains that it made yesterday. It was up 4.1% yesterday, and today it's down 3.4%. This goes to what I said at the open. Sell on green days. If you're trading, you want to sell when prices are going up, not when prices have already reached the top and they are falling. That's not when you want to sell. That's when you want to hold, right? Okay, so just looking at Ethereum here, it is above its trend line, much more so than Bitcoin. There is no death cross incoming. The 50-day moving average is all the way up to 39.20, and the 200-day moving average right now is sitting at 34.52. Now, today's high for Ethereum was 34.13, so just a few bucks shy of that 200-day moving average. So we saw it yesterday as well. It was a few bucks shy of that 200-day moving average. That seems to be a ceiling or a lid on Ethereum at the moment, and that can always occur. Your trend lines, your moving averages, they can act as support and they can act as resistance sometimes. The market is constantly changing, evolving, and you need to change and evolve with it. You should never have a static investment thesis. You should never have a static trading strategy. You can have an investment thesis, you can have a trading strategy, you should, but you need to update them as the market moves along because the environment in the market constantly changes. If there's one thing that you can always count on in the market, it is change. All right, let's do rapid fire through about 5 or so stocks that I want to talk about that had upgrades, downgrades, and things happen to them today. The first one is in the solar sector, ENPH. ENPH is the ticker symbol for ENPH. It's had a rough go for the past, I guess, nearly 2 months now in a downtrend. And this thing had a nice rally at the end of the year. But since the beginning of December, the end of November timeframe, it's just been falling. It just can't catch its footing. It tried to at its 200-day moving average when it was coming down, but it just fell right below that. Today, it was down 3.8%, another red day. Over the past 2 months, really, since November 22nd, there has only been maybe 7 green days. Every other day has been red. So this thing just can't catch its footing. But why I bring Enphase up today is they were upgraded to a buy from neutral at Guggenheim with a price target of $213. If we measure where Enphase is right now, down here at $143, and we measure up to $213, we get a 48.5% upside. 48.5% upside to Guggenheim's price target. That's a really nice gain. And right now, I'm looking at Enphase with this big decline. And if we measure this from its high right here of $282.46, which was a 52-week high, and that stands right now, down to where it is currently, well, that is a 49% downcline. 49% downturn since its 52-week high. That is an incredible discount on, in my book, a high conviction, awesome company. Enphase, for me, is the top of the top, the best of the best, and they're on sale for 49% off. When you go grocery shopping, do you buy corn at full price, or would you rather buy corn 50% off? I take the 50% off versus paying full price. Anybody would. Everybody would. And that's how you need to look at these companies that have gotten beat up. Now, you do need to be careful because Enphase is a growth company. And growth companies, unfortunately, this year are going to have a tough time at making a positive return for the year. So even though it's on sale for 49% off its 52-week high, we do need to be careful. Don't go in and open a full position at a price like this. Go in little nibbles at a time, right? With it being 49% off, take your full position, put the money aside, maybe put 1/10 of that position and buy a few shares of Enphase at this price. Then wait and watch. Maybe the thing drops down to 53% off its 52-week high. Well, then you can go in, take another 10% and buy. And what you'll end up doing is dollar cost averaging your way down to a very reasonable base price. Now, Enphase does have a 52-week low of $108. And if we go back here and look at the chart over the past year and a half, to get down to $108, we would have to go back in time to May 11th of 21. That's when Enphase was at $108. Can it get that low this year? Yes, it can. It most certainly can. So don't go in with a full position at this time. Dollar cost average your way into it. Take 1/10. And if you want to go even bigger than that, maybe split it up into fourths or thirds and just go in at it a little at a time, dollar cost averaging. That is your best way to go into this thing. I mean, look at the RSI here. Since November the 4th, the relative strength index has been steadily declining. Right now, Enphase is way oversold. The RSI is at 18.7. 30 and below is oversold. So this thing is really on sale. not just the 49% discount from its 52-week high, but also on a overbought, oversold relative strength perspective. It's cheap in that perspective. Now, valuation, it's still valued at $19.3 billion, right? Okay. Well, that's in phase. They were upgraded today. And one of the biggest reasons why, they are a leader in their industry, and they have pulled back 49% from their 52-week high. All right, another company in the solar industry is SolarEdge Technologies. Ticker symbol is SEDG. SolarEdge Technologies. Now, they were upgraded also to a buy. All right, let me get clean this chart up a little bit here. The last time I was in here looking at this chart was probably around the middle of November. I haven't looked at them since then. They had this bullish symmetrical triangle that they formed here. And usually when you see these symmetrical triangles, you get a rally, a nice big rally, usually something comparable to the distance between your top resistance line and bottom support line. And it was very close. If I show you this as an example, if we go from this low here up to straight up to resistance, that was a 63% gain. And if we measure the breakout, it's not going to be 63%, but it's 54%. So that's why I said it's a comparable. Okay. They've been brought up because if we look at where they've been for 2021, besides this symmetrical triangle that they formed, and then this rally to a new 52-week high of $389, they're also on a discount right now. The price has fallen significantly. But there's something else here of note. This bottom blue line that I have at $234 and this top line at $300. This is the range that SolarEdge Technologies has been in over the past year. Of course, they've fallen out of it two times exactly, but they've broken above it also 2 times. The rest of the year, they have been in that range. We call that range bound. So right now, it's about maybe a third off of the bottom of that range. So again, they were upgraded to a buy from neutral at Guggenheim again, this time with a price target of $329. So what's the upside percentage? Well, we take where we are now and we go up to $329, and that gives us a 26.5% upside potential. That's pretty decent. Not as much as the upside potential for end phase, but still pretty good. SolarEdge Technologies, it's in my top 5 in the solar energy. But if you have to pick one, I would go for SolarEdge. Not SolarEdge. Oh my goodness. I can't believe I said that. My apologies, Enphase. You are the one. Enphase is the top one for me. All right, staying in this solar theme, there was another upgrade for another solar company, Sun Power. Ticker symbol SPWR. Sun Power. They were upgraded to equal weight from underweight at Morgan Stanley. Now, Morgan Stanley did lower their price target to $23. They're currently at $20. But if we look at their stock chart here, take out the anomaly, that humongous run that it made back in January a year ago, and just look at how it performed over the second half of 2021. And it too has been range bound, typically with a bottom around $20 and a top around $27. And then, of course, there were the 2 times that it did rally and go out above the top of that range. But they always, on both occasions, came right back down into that range. So it is currently sitting at the bottom of that range at $20.11. And the price target was only they lowered it, but it's only up to $23. So not a lot of wiggle room there on SunPower. So this one is a little bit lower on my list. I don't even believe it's in my top 5. All right, let's leave the solar industry and let's go to Home Depot right quick because they were also upgraded. Ticker symbol is HD for Home Depot. Now, this has been a darling, an absolute winner throughout the pandemic. People were stuck at home. What did they want to do at home? Well, they wanted to upgrade their home. They needed to add a office. They needed to add a daycare center, for the kids, a place for them to have a little more comfort as well. Maybe they added, and I've seen this in a lot of new homes, or not new homes, but a new addition to a home, and that's a sunroom or a screened-in deck. That has been really, really popular here in Northern Virginia. A lot of homeowners last year, or over the past 2 years, added that specific room to their home. They either completely walled off with windows their deck to make a sunroom, or they walled off the deck with windows and screens to make it a screen room. So that's been very popular here in Northern Virginia for homes. We are currently right now looking to buy a home, and that is definitely a cool feature in a home to have. Okay, at least here in Northern Virginia. Maybe where you live, it might be a little bit different. But I do wonder, in your area where you live, what's something that you have seen a lot of homeowners add or upgrade in or to their home? Has it been adding a sunroom? Maybe updating their kitchen? What have you seen in your area? I'd love to know. Okay, back to Home Depot for a moment. As you can see, this nice rally, but before this rally, they were range bound. They had a low around $300 and they had a top around $345. Now, they are also range bound again, with a bottom somewhere around 300 and let's call this 85 $385, maybe a little bit lower than that. And then the top right here at 417. Now that I add those lines, you can really see the stock has been range bound there. I need to lower this down just a little bit. Right there. 381 as the bottom and 417 as the top. So right now, it's closer to the bottom of that range, but it was upgraded, Home Depot, to a buy from a hold at Truist with a price target of $448. Let's measure that. 400, and now I've got to adjust the chart here to get that high, to get to 448. Okay. So let's measure where it is right now up to $448, and that's a 16% move or a $61.94 gain. That's pretty nice. Now, what that does though, this spot right here is if we were to draw a trend line right here, just like this, where we matched up this point here at the bottom. It also lines up with this point right here. And then I can adjust it just a little bit to catch that bottom part right there. And then it lines up right here. Now, this is one way companies go about to get price targets. So if we go back up to that $448 mark, right there. Look at how close that is to this trend line. What that would do is that would take Home Depot out of this range that it is bound in and put it back on this trend line that it has been on for several months. It was on this trend line starting back in October the 4th of 21, and it rode that trend line up even into the range, to the top of the range, but that's where it diverged. So it's just a continuation of that trend line. That's one way these analysts come up with price targets. They extend a trend line out. Now, they use more data than just a simple trend line, but it is one way, or one thing, one data point, I should say, that they do use to come up with these price targets. And it's something that I use myself to come up with price targets when I'm doing my investment thesis on a particular company. Okay, let's go real quickly to NEO. Yes, NEO. Now, Truist, they came out with a whole bunch of upgrades today and initiated coverage on stocks today. We're going to go through a real quick rapid fire of those in just a moment. But NEO was upgraded to a buy. Ticker symbol is NEO, N-I-O. They were upgraded to a buy from a sell at 86 Research with a price target of $52. Now, NEO, let me adjust the chart here. It was in this symmetrical triangle here. You could almost call it well, I guess that's the best one to use, a symmetrical triangle. It fell out of this, and it's been finding a bottom somewhere around $27, $28. And it just can't break back above this $32 area. It's really been stuck below that. Now, with the price target of $52, if we measure from where they are up to 52, that would give us a 70.5% upside. That is a big move. But what that does, if I scrunch this up a little bit here, is if we look at this, that takes us back to the top of this symmetrical triangle. And it also takes us to this kind of resistance area right here. And also this resistance area over here. Interesting, right? So I guess they're taking like this top area here and saying, well, NEO's got there before, and with the tailwinds that 86 Research sees for NEO, it could get back to $52. It's been there before. It's got a 52-week high of $64. Okay, so that's NEO. Now, remember I said Truist came out with coverage on a lot of companies today. I mean, they really came out today. And some of the companies that they came out with buy ratings on were Advanced Auto, ticker symbol AAP, AutoZone, ticker symbol AZO, Costco, ticker symbol COST, Dollar Tree, DLTR, and Five Below, FIVE. Those are some of the companies that Truist initiated coverage on with a buy rating. That's interesting. Auto parts, yeah. Discount stores, yep. With high inflation, people are going to buy parts that break on their car instead of trading it in for a new car. They want to buy something to eat or something for their home. Well, they're going to go to a discount store for that. You've got a birthday party for your child coming up. Well, instead of going to a main retailer for party supplies, maybe you'll go to an off-brand Dollar Tree or something like that, Five Below, and pick up a few items there. Discount shopping. So I see a couple things there with what Truist was initiating coverage on with buy ratings today, and it makes total sense with the inflation that we're seeing up 7% year over year in December. Okay. Next, I want to talk about a particular stock, and I want to give you some insight on our thinking, okay? We talked about this during yesterday's live stream, just a little bit, but I wanted to go a little bit deeper today. So the company that I want to talk about in relation to this other thing is Kohl's. Ticker symbol is KSS. Kohl's. Now, Kohl's has been range bound with a low of about $46, $45 and a high of about $57 to $58. And it's been range bound for the majority of 2021 and into 2022. It's just not kicking off the ground. It had a really nice run up October and into the beginning of February. Then it was over. And it's been moving sideways in this range ever since. Now, Kohl's is a new addition to our dividend stocks list, or like we call them, yield leaders. Yield leaders. This list, as we like to call them, yield leaders, Kohl's, in our updated dividend stocks list, or yield leaders as we call them, Kohl's is in the number 8th position. Out of our top 10, Kohl's is in the 8th position for a dividend paying stock. But we look at it not just as their dividend yield, we look at it as a little bit more. First, their story. So Kohl's, the department store giant, handedly beat their EPS estimates when it reported Q3 earnings in mid-November. However, analysts remained bearish on the name amid concerns about sluggish top-line growth, supply chain problems, and inflation. Just last week, UBS downgraded Kohl's to sell as the firm expects inflation will weigh heavily on earnings. Last month, activist firm Engine Capital sent a letter to the board of directors arguing that Kohl's should conduct a review of strategic alternatives. The firm is recommending that Kohl's consider spinning off its successful e-commerce segment, which it thinks could fetch $12.4 billion market cap all on its own, well above the $6.67 billion market cap for the entire company. This is similar to what Jana Partners is advocating for Macy's, ticker symbol M, to do. Regardless of whether that happens or not, Kohl's has been a serial underperformer, and if the stock cannot move following a huge beat in Q3, maybe it should considering a spinoff. Looking ahead, though, the main concern is obviously supply constraints. Kohl's has a good amount of production coming from Vietnam, and there have been COVID shutdowns over there. To its credit, Kohl's says it has taken these risks into account when it recently increased full-year adjusted EPS guidance to $7.10 to $7.30 from prior guidance of $5.80 to $6.10. The new guidance computes. I can't believe I just said that. Oh my goodness. The new guidance computes to a very reasonable PE of 6.9 times at the midpoint, and a forward PE of only 7.5 times. So the stock is quite cheap. In my data for Kohl's, it scores a high shareholder yield of 98 out of 100, while its relative strength is at 51, and that's quite low. So it has not run away like many other retail stocks. There is a lot of negative here, and inflation will be a headwind. But I like the risk reward at these current levels. Plus, Kohl's has been aggressively buying back shares with a 10.2% buyback yield, and it pays a nice 2.1% dividend yield. So the total yield for Kohl's, and this is important, the total yield for Kohl's is 12.3%. Most out there claiming that here's the best dividend stocks only look at the dividend yield. And Kohl's is 2.1%, but you have to add the 10.2% share buyback because that also causes a stock price to appreciate. So the total yield, 10.2 plus 2.1, gives you the 12.3%. This is what I was trying to get at yesterday when talking about what a company pays an investor in its yield. And it's not just the dividend yield, but also the share repurchase program combined, which gives you the total yield. Then you take into account the stock's story to weigh your risk reward ratio and whether or not it fits into your portfolio. So there's 3 of the key data points to look at when you want to find a good dividend paying stock. Dividend yield, yield from share repurchase programs, and the stock's risk reward, the stock story. Once you have those 3, you add them up, and that tells you whether or not it fits for you in your portfolio. So right now, Kohl's at this moment in time, because the market is fluid and constantly changing, is at number 8 on our top 10 dividend stocks list. Now you can get this list by clicking the first link in the description. All right. Let's do a deep dive on KB Homes and their earnings that they reported today. The ticker symbol is KBH. Now, when you look at the stock chart here, there's a lot of companies range bound right at this moment. KB Homes is one of them. They had the rally, and recently, over the past 6 months, they've been trading sideways. This is the story for a lot of stocks right now. They were up 16.5% today. This was a company in our Catalyst Watch video from Sunday evening. That is a must-watch video. It's the most important video I do all week. 16.5% gain today from KB Homes. Now, if we go in here and look at this, they were range bound, right? By the time earnings came out, they were in the middle of their range. And then they soared all the way up here. Let me put a circle around that just to make it a little more obvious of where they are at right now. And that's right there. Change that color because red is negative, and this definitely is not negative. So it started out down here in the middle of its range, and it just shot up to the moon. Now, I would say that KB Homes, ticker symbol KBH, Their shares are through the roof today after the home builder capped off fiscal year 21 with a sizable Q4 earnings beat and upbeat fiscal year 22 guidance. After KB Homes and their peer, Lennar, ticker symbol LEN, well, Lennar missed on earnings last month as supply chain woes persisted. Investors were quick to sell off the stock, causing KB Homes to dip right in line with them. However, as a result, much of the bad news that came out of Lennar's earnings report was already priced in for KB Homes, leaving ample room for significant upside from a solid earnings report. Diving into KB Homes' excellent Q4 earnings, the company beat on EPS by double digits, a sharp reversal from the earnings miss it posted last quarter. A primary reason for this was the 140 basis points year over year improvement of KB Homes' excellent adjusted gross margin to 22.4%. More notably, still than that, KB Homes expects margins to expand to 26% for fiscal year 22. Also, despite missing revenue estimates in Q4, KB Homes announced that its backlog, that its value in backlog homes jumped 67% year over year and 2% quarter over quarter to $4.95 billion. KB Homes expects the bulk of the backlog to be realized in fiscal year 22, establishing a firm foundation for KB Homes to expect housing revenues of 7.2 to 7.6 billion in fiscal year 22. As a particularly standout, KB Homes backlog, that value expanded despite a 10% decline year over year in net orders in the quarter. This resulted from continued appreciation in housing prices, reflected in KB Homes' net order value jumping 12% year over year. In fact, in Q4, the average selling price grew quarter over quarter for the third straight quarter to $451,100. Furthermore, KB Homes does not expect housing prices to come down anytime soon, forecasting a 5% jump quarter over quarter in Q1 to $472,000. The company also expects the average selling price to remain significantly higher for fiscal year 22 at about 480,000 to 490,000, a 15% increase from fiscal year 21. Numerous factors contribute to the elevated housing prices. On the demand side, KB Home sees first-time buyers continually looking to purchase new homes. During its November earnings call, Lennar also noted the same thing, observing that many millennials now in prime family forming years are shifting from apartments to houses for the first time. Also, many individuals are still moving from city centers to suburban areas in a pattern fueled by the pandemic. The National Association of Home Builders found in Q3 21 that even though home building in higher density markets is starting to recover, the suburban shift towards single family home buying has continued. A tight supply is also factoring in extensively to the ongoing rise in housing prices. In Q4, KB Homes built times stretched out an additional 2 weeks quarter over quarter. Lennar noted that the same extension in its build times as well in the quarter. However, KB Homes noted that construction times in November and December were consistent with September and October, a sign of stabilization over the past 4 months. Furthermore, KB Homes expects those levels to hold out for 2022, a bullish signal that it can deliver on much of its backlog in the coming year. Overall, KB Homes Q4 results indicate a very hot housing market that is not expected to cool off in 2022. Even as build times stabilize and supply begins to normalize, I believe that trend pull. I should back up, slow my thoughts down. I believe that trends pulling on demand will continue to outweigh improved supply, keeping housing prices elevated throughout the year. On a final note, despite the massive appreciation in KB Home shares today, 16.5%, they still trade at an attractive 5.5 times fiscal year 22 earnings, a significant discount relative to Lennar at 6.9 times and DR Horton, ticker symbol DHI, at 7.1 times. Now, Lennar did increase its annual dividend by 33% to $1.50 today. That was a pretty big improvement. KB Homes right now pays a 1.42% dividend. Okay. So there's a deep dive on KB Homes and their impressive earnings report today. And the share popped 16.5% off of this wonderful news for the company. Not so much for someone in my situation looking to buy a home, unfortunately. But for shareholders, bravo. All right, let's look at another company that reported earnings today and do a deep dive into their earnings, and that's Taiwan Semiconductor. Ticker symbol is TSM. Give me just a quick moment. Oh, I apologize. Okay. Taiwan Semi, TSM. Let this stock load here. Look at them. All right. If we bring the chart in here, over 2021, and I talked about this in Sunday's Catalyst Watch video. Over 2021, Taiwan Semi was range bound. A bottom around $108, a top around $124. And it could not break out. Now, Taiwan Semi last year was doing pretty good. They beat on their past 2 earnings. 3 earnings ago, if you're counting today, they didn't do as well. But that was the only one. If we go back and look at these other earnings here on the screen, they all beat. Yet they were range bound. And they were producing something that the world needs a lot. We need chips in many areas. So seeing it range bound to me did not make sense. But today, with this recent rally and today's big move, look at this. This big gap up right here. And it reached a higher point today and then pulled back some into the close. But it was up 5.2%. It got up to or it closed at $139. So a deep dive on Taiwan Semi, ticker symbol TSM. Taiwan Semi had a fabulous into fiscal year 21 as its revenue growth reached over 20% year over year in Q4, a return to growth rates not seen since Q3 of 2020, over a year ago. Growth for the chipmaker's bottom line was also strong. Earnings rose 16% year over year to NT 6.41 per share, topping estimates by double digits. Being the world's most valuable and largest semiconductor manufacturer, Taiwan Semi paints a really good picture of the overall semiconductor industry through its earnings report. As such, one of the most notable comments from Taiwan Semi during its Q4 earnings call is that it expects capacity to remain tight throughout 2022, even as in markets such as automotive, PC, data centers, and mobile are creating products with higher silicon content. Despite this tight capacity, Taiwan Semi predicts that the foundry, or yes, the foundry, the foundry industry should grow close to 20% for the year. Taiwan Semi is optimistic that it will outperform this expected industry growth. Another takeaway from Q4 is that operating margins grew by 50 basis points year over year, slightly ahead of Taiwan Semi's guidance of 41.7%. Even more remarkable, the company expects margins to continue to improve in fiscal year 22, forecasting a range of 42 to 44%. The low to mid percentage growth across most of Taiwan Semi's business units contributed to the decent margin improvement in the quarter. One highlight came in from the automotive side, where revenues jumped 10% year over year, although automotive only accounts for 4% of total Q4 revenues. The jump is significant as it shows that the automotive industry is continuing on in its path of recovery. Not only is the growth much higher than the minor 5% jump last quarter, but it also builds upon a leap of 27% already achieved in the year ago period. Looking ahead, I think a big contributor to the stock's movement today, along with the company's expectations for continued margin expansion in fiscal year 22, is Taiwan Semi's Q1 revenue guidance. The company expects revenue of between $16.6 and $17.2 billion for the quarter, totally smashing estimates. High performance computing, or HPC, is expected to be the driver behind sales growth, coupled with further factory or recovery in automotive. Both should more than offset Taiwan Semi's forecast of a milder smartphone season compared to recent years. Lastly, Taiwan Semi predicts that 5G and HPC applications will be major themes over the long term. Both industries should ignite a further jolt in the smartphone, automotive, and Internet of Things markets, just like I said in the Catalyst Watch video. Given the enhanced capabilities of 5G and HPC enabled, Taiwan Semi is thus guiding to long-term revenue in US dollars between 15 and 20% over the next several years. Overall, Taiwan Semi's Q4 results point to increasing demand for chips in many additional applications moving forward. I also like seeing that the automotive industry is continuing to recover. Although I was slightly concerned about Taiwan Semi's efforts to seemingly stockpile chips in the previous quarter, I did say that 3 months ago. Given that a downturn could result in substantial losses of product, the company is continuing to secure payment from its customers, reducing this risk in the process. The bottom line, I believe 5G and HPC themes should play out nicely in fiscal year 22, setting up Taiwan Semi for a very strong year ahead. But what do you think about Taiwan Semi and their chips? Are they doing the right thing? Are they moving in the right directions? And do you see these same themes playing out in 22? Let me know in the comments below. Okay, let's move on to some catalyst watch for tomorrow. Big banks report before the opening, and I've got two that I'm watching closely. The first is Jpmorgan Chase, ticker symbol JPM. How are they going to do? Remember, in the video that I put out earlier today about Jefferies reported their earnings yesterday. We talked about them in yesterday's live stream. Jefferies is typically a crystal ball, a guiding force, a gauge for the big banks. If Jefferies does good, then you can expect a significant blowout from companies like JP Morgan, Wells Fargo, Citi, and others. But Jefferies yesterday did not have a blowout quarter. So is this gauge now being deconstructed? Is there no longer a correlation between how well Jefferies does compared to how well the big banks do? We'll find out tomorrow morning. Because Jefferies, well, it did have some improvement in investment banking. In other areas of fixed income, it maxed out. Its growth reached a ceiling. So, how's JP Morgan going to do tomorrow? Now, they post their earnings tomorrow before the market opens. They have an estimated EPS of $3.06 on revenue of $29.69 billion. Now, the other one I'm watching for tomorrow, and I actually like this bank a little bit better than JP Morgan, and that's Wells Fargo. Ticker symbol WFC. Now, Wells Fargo, they also post earnings tomorrow with an estimated EPS of 99 cents with revenue of $18.62 billion. Out of the big banks, Wells Fargo has the best risk-reward ratio, and it also has a lot of outperform ratings from analysts. With this rally that it's had in 2022, is it a possibility, especially with what happened with Jefferies yesterday, that earnings are now priced in? It's a question that I'm struggling to find the answer to. All right, so those are the two big banks I'm watching closer than others. Citigroup also reports tomorrow as well. Okay, so there's today's show. Now, one of the most important things that you can do, if you found this video to be helpful, informative, actionable, then click the like button. The second thing you can do is take the URL and share it everywhere. And then the third thing you can do is click the first link in the description to get access to our top 10 growth, our top 10 value, our top 10 dividend, and our top 10 momentum stocks. They are constantly updated, so you always have the best names to choose from. We're doing this to help you be financially free. That's our goal. Financial freedom for all. All right. Thank you guys so much for watching. I'll go ahead and wrap the video up here. I greatly appreciate everyone tuning in for today's episode. And Yeah, that's it. All right. So remember, you can click the first link in the description or the link in the live chat to get our top 10 value, growth, dividend, and momentum stocks and so much more. We've done the research so you don't have to. Thank you so very much for watching, and I'll see you in the next video.